Welcome to Intuit's Bookkeeping Certification Program. This program is made up of 4 courses: Bookkeeping Basics, Accounting for Assets, Liabilities and Equity in Accounting, and Financial Statement Analysis. Each course has similar activity types. These include videos, discussion prompts, and practice. In the videos, you'll meet your bookkeeping coach, Bianca. Bianca and her Bookkeeping Rescue Show will make an appearance throughout each course. You'll go through bookkeeping topics and situations with Bianca as a guide. The discussion prompts are your opportunity to think about what you've learned and consider what it means for you. Lastly, practice will consist of quizzes and interactive activities where you can self-check what you've learned. Now that you know what's waiting, you're ready to start. I'd like to welcome you to the first course of the series, Bookkeeping Basics. At Intuit, we believe in powering through prosperity by giving people access to tools and knowledge to enable them to take control of their financial and personal lives, which is why we built this certification. Since you're here, it's clear that you have an aptitude for numbers and want to know more about the world of accounting. Maybe you're looking to switch careers, maybe you're a small business owner, or maybe you just have an interest in bookkeeping. Whatever the reason, we're honored to be a part of your journey to becoming a bookkeeper. Now, before we get into specifics, let's talk a little bit about how the courses work. Each course in this certification is broken down into 4 modules, and each module contains 3 to 4 lessons. In each lesson, you'll find a variety of content, including advice from experts, hands-on practice activities, readings, knowledge checks, graded quizzes, and peer discussions. In this first course, Bookkeeping Basics, you'll be introduced to the role of a bookkeeper and learn what bookkeeping professionals do every day. You'll dive into foundational accounting concepts, work your way through the accounting cycle, and become familiar with key financial statements. The practice you do throughout the course will prepare you to complete a real-world case study, in which you'll be asked to work with a client and perform the various duties of a bookkeeper. When you have completed this course, including the final project, you'll have the skills to define accounting and the concepts of accounting measurement, explain the role of a bookkeeper and common bookkeeping tasks and responsibilities, summarize the double entry accounting method, explain the ethical and social responsibilities of bookkeepers in ensuring the integrity of financial information. While there are no prerequisites to participating in this course, to be successful, you should allow yourself time and space to focus, be open to learning new concepts, come ready to practice and apply new knowledge, learn from mistakes, and perhaps most important, have fun expanding your skills. Now, before you jump in and begin your bookkeeping journey, I want to leave you with a few parting words of advice. First, the intention of this course is to be flexible and fit into your life. You don't have to complete everything in one sitting. With that being said, we recommend that you allow yourself roughly 4 to 6 hours per week to review and complete the course material. Second, as you'll soon find, the content topics and skills build on one another, so you'll have several opportunities to practice important concepts. And lastly, remember, as with learning any new skill, you might not get it perfectly right on the first try. The important thing is that you keep practicing. Good luck and happy bookkeeping!
When I was a kid, my dad lost our family business because of a crappy bookkeeper. I'm sorry? Can I say that? I just did. Well, it's my show. Anyway, he was. My dad was crushed and our lives were changed forever. That's when I decided that no one would ever go through that on my watch. Business owners on my Bookkeeper Rescue Show need our help getting out of their bookkeeping nightmares. Listen, it's a hot mess. That's why I'm here. God knows I love a great pair of pumps, but you can't operate a business out of a shoebox. And they need our help setting themselves up for success in the future. I'm a storyteller at heart. I've realized that bookkeeping is a way to tell a business's story using numbers. I've been helping other small businesses tell their stories ever since. But enough about me. Let's hear from a few others who'll talk about me.
Bianca, seriously, you're awesome.
I appreciate it, but you don't have to say all that.
No, it has to be said. Before you came here, we were...
A flaming hot mess? Listen, shoeboxes are for shoes. Oh, aren't those adorable? So, lucky you, my new intern for this season of Bookkeeper Rescue. I expect a lot, but if you stick with it, I'll get you ready to start your own bookkeeping career. Maybe I'll even put you on the payroll. Well, enough yapping. We got a business to take care of. So, yeah, I may have decades of bookkeeping know-how under my belt, but I bet you know more about tracking finances than you think. For instance, have you ever tracked how much money you make in a week or month? Have you ever tracked how much you spend on different types of purchases? Yeah? Well, look at you. You got a basic understanding of money in, money out. I can work with that. Just imagine trying to run a graphic tee business without knowing how many t-shirts you can afford to stock, how much money someone owes you, or how much money you made. What a nightmare. Stress, tax problems, legal issues. I don't like attention, but that's not the kind of attention I'm looking for. Am I right? But we'll get to the down and dirty details of bookkeeping and accounting later. For now, just know bookkeeping practices can make or break a business. What bookkeepers do and how they do it is important. We're more than data entry clerks. And don't ever let anybody tell you different. Excuse me. Okay, let me stop yapping. We gotta have a game plan here. This is a very busy season for the show. Here's the plan. Did your mouth drop at some of those words? Don't worry. Stick with me and you'll be speaking like a bookkeeper in no time. Speaking of time, to get the job done, I'm going to need you here about 4 to 6 hours each week. As you can tell, I like to mix things up, so be ready to learn through different ways. All right, we got one. Let's see what we got here. This guy's family called me because they're concerned about his business and if it's making money. You know, the reason why you start a business? Sounds like they tried talking some sense into him and getting him help with his books. But he's not listening. I tell you what though, honey, that's not gonna fly with me. All right, let's go meet this guy and see what kind of a mess he's gotten himself into. Okay, Lou, sweetie, your family called me because they have some concerns. They're worried that your business might be losing money.
Shoot, they're just sticking their noses where it doesn't belong. I've been landscaping since before they were out of diapers. What do they know?
Lou, listen. Cutting grass and running a business are not the same thing. Tell you what, let me take a look at your books. If they're good, I'll leave you alone. And if they're not, maybe we do a little work together, okay?
Fine. Whatever gets you out of my hair faster, lady.
Lou, honey, what is this? I asked for your financials, not your English homework.
Hey, listen, I have a system.
A system? You call this a system?
Yeah, it's worked for me so far. So I don't need someone coming in here and telling me what I'm doing isn't working.
Ugh, I have met so many Lou's in my life. Everyone thinks they can run a business on their own with no help. They don't stop to think about what a bookkeeper could do for them. Now that I think about it, a lot of people don't know what a bookkeeper does. So let me tell you, bookkeepers are like a good Chianti. We're not the star of the meal, but we just make everything work better. Tell you what, let's take a closer look at bookkeeping and what a bookkeeper does. You know, not for nothing, but bookkeepers do more than just collect receipts and mess around with numbers. We also play a large role in the success of a business. Depending on the type of business I'm working with, I wear a lot of different hats. In other words, that means if I do my job, business owners like Lou here don't have to worry about things like taxes and financial statements. They can just focus on doing what they love most, running their business. You know, I have this one bookkeeper friend, Christy. She's amazing. She told me this story about her dad and how it led to her career in bookkeeping. Oh, such a beautiful story. I had mascara running down my face. I just can't do it justice. Let me just let her tell it.
My dad had just retired from the military and he did not know what he was going to do. His best friend at the time suggested that he open up a Renaissance festival, which was a pretty crazy and outlandish idea, but he decided to go for it. The Renaissance Festival quickly became something from an idea to like a work in progress. I remember coming home after work one day to visit him, and my old bedroom had been turned into an office with this big, huge map. And there was all of these pins for different locations of where they were going to put this festival. And it was clear that my dad was going to definitely go through with this crazy idea. Then I remember when the festival first opened, actually walking on the property and realizing that this thing was just this dream had become this very real, very tangible thing as a business. And so that moment, the realization that something can become an idea to a very real business really inspired me to want to help these people achieve their dreams, turning this idea into a reality. And so that is how I got pulled into accounting. This is my way of helping those people build their dreams and make those dreams their reality and help that reality grow.
Need a new and rewarding career path? Looking for growth and opportunity? Not sure where to start? At Right Path Careers, we have compiled knowledge and advice from experts and created our very own guide to help you plan your job search. Advice for applying for jobs, ways to track your job search, even tips for getting interviews. All in a beautiful digitally bound PDF. Now, who could say no to that? But wait, there's more. No, it's not a set of knives, but we are slashing prices. Act now and get this helpful PDF of $49.99 value absolutely free. You heard that right, F-R-E-E free. But hurry, this offer expires soon. Are you a bookkeeper who's been asked to do something that violates your code of ethics, your morals, maybe even the law? Not sure how to respond to your client about proper bookkeeping procedures, or what you can and can't do for your client? Well, don't fret. We here at Ethical Bookkeeping are here to help. Our experts are here to provide you with their years of wisdom and expertise. Don't believe us? See for yourself.
We have had times when we work with a lot of nonprofits and they don't always understand exactly how to do things where, for example, if a donation is given to a nonprofit and it's given with a person's name on it, that can actually disqualify the donation as tax deductible by the donor because they're intending it to be for a specific person. And since nonprofits are not supposed to be receiving money for specific people, that could become an issue. So we will often look up guidelines to advise our clients about how to handle those types of situations. And so we can help them, instead of saying to the donor, as an example, don't give a donation in someone's name, we say, we would ask that you do it this way. So we teach them how to do things a little bit differently. Another example that has come up on the bookkeeping side that's more of a for-profit type of scenario would be treating somebody as an employee, but paying them as a contractor. And so we often will bring up those kinds of conversations and guide them toward how to handle that. You know, what does it mean to have an employee? What does it mean to have a contractor? And we discuss those types of topics with our clients and help them to understand what they should do Ultimately, it is the client's decision and they have to live with the consequences of those decisions, but we'll walk them through that. One scenario I can think of in particular that was really quite interesting was when a small business owner had a lot of expenses related to alcohol purchases and other types of purchases that were clearly personal in nature and were not able to be classified as business expenses. There was no clear indication that those were business expenses in any way, shape, or form. So as part of what we were doing, we automatically classified those as owner draws or personal expenses that the owner paid for, which would be counted that way. And the client was very concerned about that because they had spent a lot of money and wanted those as deductions. And we helped them to understand that if they would like to reclassify those themselves, they were more than happy, but we could not ethically count those as business expenses because they were not business related.
All right. I get it. My bad. We'll go ahead and record the $50. This bookkeeping thing is making my head hurt. Maybe my family was right. I could use some help.
You're doing the right thing, Lou. Both for your business and your family. I just want what's best for you.
I know I can be hard-headed and a bit set in my ways, but I do appreciate you looking out for me.
Lou, it's my pleasure. It's why I'm here. Now that I got you on board, let's get your books going. I need to know everything. Assets, liabilities, the whole nine.
You kidding me? You really need all that?
Believe it, honey. And it better not come to me in a shoebox or a ratty old notebook. So, Lou, sweetie, this is how you keep track of your business finances? How's that working for you?
Yeah, it's what works for me. Why change a good thing? Look, here's Mr. Mahone. He wants his shrubs trimmed only once a month, so he pays me once a month. Oh, looks like I forgot to get last month's payment from him. I'll call him. See? It's all here. It works. And the box is where I keep all the receipts, all together in one spot. Well, in a few boxes. Perfect.
Lou, listen. This is a hot mess. That's why I'm here. I love a great pair of pumps, but you can't operate a business out of a shoebox. I don't even know what to say. Look, just give me your shoeboxes, and I'll figure things out from here. Lou's notebook is not cutting it. He has customer notes, payments made, and past due payments all in the same notebook. It's unorganized. It's not secure. It's a mess. And what happens if he loses that notebook? And then there's a shoebox full of business and personal receipts jumbled together. Lou needs bookkeeping basics. We're going to start with the accounting equation to show Lou the story of his business's financial position. It will be a lot of work, but we'll make sure his story has a happy ending. That's a Bianca guarantee. First of all, Lou shouldn't be mixing his personal and business expenses. Lou's lawn care expenses should be the business expenses and the business expenses only. You can never mix business and personal expenses in bookkeeping. That's like mixing orange juice and milk. You just don't want to do it.
It can be a little challenging for business owners who are just starting out to have that line drawn in the sand as to what's business, what's personal, because they are building their company from the ground up. And so it's very personal to them. And they do invest a lot of their personal lives into their business. And so it can get a little blurry in that, personal and business assets can be a little combined at times. I have experienced that. She had a massage therapy company, and so she had oils that she would use. And so there were times when she would purchase it for herself, and then other times that she would purchase it for the business itself. And so I had to go through and walk her through how to differentiate the two, as far as whether it was a business or personal expense. And so as you walk through, they start gathering that information, the clients do. And so they start seeing how it can affect their business and their bottom line, which is something that is ultimately what they want to see as a positive thing. She was quite receptive. The main reason she was receptive was because I explained to her that it will affect her profit and loss on that business. So if she didn't differentiate the two, then she would be looking at a loss for her business. And so although she did not want to have to pay extra taxes or any of that sort of thing, but she wants to have the truth of her value of her company.
That was some serious thinking. Just remember to keep the A equals L plus E equation balanced by making sure you accurately account for all assets, all liabilities, and all equity for the business. You made it through your second episode. First class work. Let's look at what you've learned. You'll continue building on these accounting fundamentals throughout the rest of the course.
A new job? The whole apartment complex? Am I able to take it on? Let me get back to you.
Lou doesn't know if his business is positioned to expand and take on such a large client like this. But with the information we have so far, and a lot more work, we can put together some core financial statements and have him making the right kind of decisions for the big-time guy he could be.
This would be the biggest job I ever took on. I'll need at least one more mower, an additional crew, probably another vehicle, and there's always stuff you didn't plan for.
The old spend money to make money conundrum. What? I can't drop a big word every now and then? So, Lou, how are you going to pay for these new expenses?
A loan? A line of credit?
Oh, okay. And do you know what information you're planning to show the bank for your loan? Please don't tell me you plan to walk in and hand them that mess. I've got 2 words for you. Financial statement. The bank will want to see your business's financial statements before they even consider lending you money. Otherwise, how do they know you can pay them back? They're a business just like you.
And I can find these financial statements where?
You don't find financial statements. They don't grow on trees. Give me that notebook. And are these all the shoe boxes? I'm gonna need a minute. Can you get me a scone and some coffee? Uh-huh. I knew you were a smart cookie. You noticed that $50 was recorded twice. This is because we're using double entry accounting. It's the most common way bookkeepers record transactions. Double entry accounting is a way of bookkeeping that tracks which accounts increase and which decrease for a given transaction. Increases and decreases are recorded in the debit and credit columns, and the total debits and total credits for a transaction have to be balanced. Nice! Debits to the left, credits to the right. And now, the million-dollar question. How do you know if something is a credit or a debit? It depends on 2 things. Which type of account are we talking about? Is the balance increasing or decreasing? You still with me? Good. There are 5 account types. The first 3 you'll remember from the balance sheet: assets, liabilities, and equity. And you have seen the other 2 account types on the income statement: revenue and expenses. We can combine these to form an expanded accounting equation. Moving expenses to the left side gives us the account types on the left side of our updated equation generally have a debit balance, so we increase the balance with a debit. The account types on the right side of the equation generally have a credit balance, so we increase the balance with a credit. I know, it can be a little confusing at first. With practice, it will make more sense. Some bookkeepers like to use the acronym DEA-LER. To increase an account, you will debit an expense or asset account, but credit a liability, equity, or revenue account. Time for a quick recap. In a T-chart or journal entry, debits are always on the left and credits are always on the right. Depending on which type of account it is, we either debit to increase the account or credit to increase the account. And we can use the handy DEA-LER acronym to remember which is which. Remember the journal entry for Mrs. Dow? Here, you can see it's really two T-charts combined. So if you can fill in a T-chart, you can fill in a journal entry. Practice time! Kind of fun how one transaction can impact an assets, liabilities, or equity account and a revenue or expense account, right? Remember, in the end, the debits have to equal the credits for each transaction. It's like the cardinal rule of bookkeeping. I'm going to keep working on Lou's journal entries. You go ahead and check out this video from another bookkeeping expert.
So when I work with bookkeepers, especially those that are just starting out, the whole debit credit story can get very confusing. And early in my career, nobody really told me how to handle that. You know, what's a debit, what's a credit? I learned on the job, didn't go to a bookkeeping academy or anything. So what I did is I realized one day that when I enter a check or an expense, which is most of what you're doing, I mean, that's the majority of the work you're in, I just remembered one day that an expense is a debit. So when I enter a check, I know that the bank account's the credit account and the expense is the debit account. So it was just a way for me to just lock that in. So I know if the expense side is a debit, the bank is a credit. So if it's a loan payment, the money coming out of the bank is the credit, so you're debiting the loan. And I just kind of work my way through it in that way. A lot of other accountants and bookkeepers have a nice little cheat sheet that they keep on their computer for a while until you can memorize which accounts are normally naturally debit accounts and which accounts are normally naturally credit accounts. And we do have a worksheet for you to help you with that. I just want to make you really comfortable because I've done mentor work with accountants, CPAs, and believe it or not, even people at the CPA level still don't have this memorized or completely locked because they're not necessarily doing books every day. And so I've run across quite a few accountants who have debit credit cheat sheets right next to their computer just so they don't have to think too hard when the question does come up. It's just right there, just glance at it. So my cheat is debits, expenses or debits. That's a good starting point. And then, you know, use the cheat sheet from there.
Aha! I see you thinking like a bookkeeper. You learned a lot. You know how to.
Oh, nice. Is this my financial statement?
Oh, no, mister. We have a lot more work to do. This is only the first piece. Hey, where's my scone? Look at you with your recording transactions in the general journal self. I'm so proud of you. Soon, you'll be creating even more journal entries that show all the transactions that took place over the past week, month, even the whole year. Do you know how this could help Lou get a handle on his finances? This could impact his family for years to come. You know, in a good way. It's such a beautiful thing. Oh. Okay, where were we? Oh, we're still here in the accounting cycle. You remember Lou's shoe boxes full of receipts we organized and added some to the general journal? I know, it pains me to even think about it too. So now we need to move all those journal entries into the general ledger. It's like these gourmet jelly beans. These jelly beans are all candy, just like the journal entries are all transactions. Now, if we separate these jelly beans by color, we've organized them into categories. If we want the tangerine ones, now we can get to them right away. Like with journal entries, we'll organize them on the general ledger according to the account involved. This way, Lou can get a better picture of his finances. At the end of the day, the journal is simply a list of transactions organized chronologically. What we want to do next is reorganize all the journal entries and group like items together. In bookkeeping lingo, this is called posting to the ledger. Oh, snap! I got so into the jelly beans and general ledgers, I forgot to tell you about
The chart of accounts.
Here's the thing. You need the chart of accounts because it lists all of your account types and even sub-accounts. It helps you separate expenses, revenue, assets, and liabilities. And it can organize financial information and help generate more accurate reports. You even have the flexibility to add custom account types that work best for your business. Did you notice something I didn't point out? Yep, account numbers. They can be created by the accountant, the bookkeeper, the owner, or any combination of the three. Let's take a closer look at the chart of accounts.
So the chart of accounts can be a little bit confusing. I remember early in my bookkeeping career looking at it and just realizing that it's not in alphabetical order. There's all these different names and types, and I just, chose to ignore it for quite a while because I didn't really understand what was happening on a lot of this areas on the chart of accounts. So I finally figured it out. I don't know when I had my epiphany, but basically it's organized not by the name, which is why it's not alphabetical, not by name, but it's organized by type. And what you're going to see at the top of the chart of accounts is assets and bank accounts. And you can kind of see all the assets are together here. What assets are is stuff that the company owns, has value. So what do they own? Well, they have cash in the bank, which is good. That's theirs, belongs to them. Accounts receivable is also considered an asset. It's money that's going to be in these bank accounts, hopefully in the next 30 days. So this 42,000 should turn into cash really quick. So that's an asset. Other things might be inventory. Maybe they bought some trucks, some computer equipment, all the stuff the company owns. Next, we go into debt. So as soon as we get past that last asset account, we're in debt. Well, not in debt, but we have debt. Accounts payable or unpaid bills. We've got credit cards, right? Gonna pay that off pretty quick. Payroll liabilities, those should be paid out about monthly. What else do we have? Other current liabilities, a client retainer. We took some money in, but we're gonna apply it to an invoice hopefully soon. And then long-term liabilities would be like a loan, loans payable that might be more than a year. So again, order of liquidity, credit cards and AP, you're gonna pay off pretty quick. 401k and these other payroll liabilities, that's gonna be paid probably every month. But then this loan for the car, probably gonna be a few years, 6, 7 years on that. So what you're doing is you're taking your assets at the top and subtracting liabilities to get something called equity, which is the value of the business.
You knocked journal entries and ledgers out like a pro. Mark my words, my old school way of learning how accounting works will help you when you're out there on your own, tracking down mistakes, and maybe later in your career, giving advice. But in all honesty, and don't call me out of my name here, most bookkeepers use software through the accounting cycle. Accounting software can isolate information and run all types of reports. It also automates journal entry creation and ledger posting tasks. You can see how after this quiz.
This seems like a lot of effort. How will I ever keep up with all this?
I thought you might say that. Don't worry, I've got you covered.
What's this for?
Automation.
I'm listening.
We could keep creating journal entries and posting to the ledger manually, or we could let accounting software do a lot of the heavy lifting for us.
Okay. We can give it a try, I guess.
We're making progress. Today's accounting software aims to make bookkeepers' lives easier by automating many of the processes that were once done by hand. When I show you the software, you'll notice that when you take one action, behind the scenes there are actually multiple things happening. And since you've learned the long way, the behind-the-scenes action will be a piece of cake for you to get. That way you'll know what information to change if needed. So far, you've learned how to record a transaction in the general journal and transfer or post it to the general ledger. With software, you'll enter a transaction once, and behind the scenes, it will be accurately recorded in the journal and the ledger. You want to try this or what? To start, we're going to use Mrs. Dow's $50 payment for mowing and weeding. Once the $50 is entered as a payment, it will automatically appear on the general ledger. At the same time, a journal entry will be added behind the scenes. Same thing happens when you record an expense. Don't forget that for all transactions, you must select the correct account and then categorize it correctly. If you don't do that, you will have a hot mess. Balances will be off, reports will be incorrect, and you don't want any parts of that. Let's see what happens when we add Mrs. Dow's payment. Click the name or service for the transaction on the general ledger to open it. Click the More tab at the bottom and then select Transaction Journal. See how the automatic journal entry is created behind the transaction? Notice that the check adds a debit of $50 to the checking account and a credit of $50 to accounts receivable, just like when you did this manually. Speaking of doing things manually, even with software, you might need to add a journal entry manually.
So occasionally you might be instructed to post a journal entry. Usually with QuickBooks Online, we don't want to do journal entries unless it is an adjusting journal entry, and it's usually crafted by the CPA or maybe even the tax preparer, and it comes on to the role of the bookkeeper to get those entered. If I've been instructed to do this, let's say it's a depreciation entry, let me first show you on the chart of accounts what it looks like now, and then we'll do our journal entry to complete the moving of the money, basically. So this is a chart of accounts. And again, at the top, we have assets. And every so often, you need to enter a depreciation entry. And you can see we've got $21,000 in a negative figure here. What's happening is when you buy, let's say this truck for $67,000, this truck is not worth $57,000 for the life of the truck, right? What's going to happen is you pull that thing off the lot, it's already worth less. You start putting miles on it, it's worth less. You get a dent in it, it's worth less. So it's an asset to the company, but it's wearing out, wear and tear. So that's what depreciation basically represents. And there's certain ways of calculating depreciation. Again, I stay out of that wheelhouse. I'm a bookkeeper. I let the accountant do that and give me the numbers. So basically we're going to reduce the value of assets, these fixed assets, each year usually with a journal entry. So what I need to do is follow my instructions and enter a journal entry to write off, let's say it's supposed to write off at $15,000 a year. So what we're going to do is I'm going to go to the new button and I'm going to create a journal entry. And again, these are usually once a year, but you could do this monthly, like split the 15,000 out over month to month and do them. But let's just say at 12/31/20, we're going to enter this and we're going to go to, I'm going to just type it, accumulated depreciation. QuickBooks will search for it. And that's the account I just showed you on the chart of accounts. Okay, in this case, we are going to credit the asset, which is going to reduce its value. So I'm going to put in $15,000 and we'll put in the description 2020 depreciation. Usually I like to attach the depreciation schedule or whatever it is the CPA or the accountant sent over to me. So there's a supporting document here. And then here we're going to write off $15,000 in the value of this worn and torn truck that we've been using. Okay, so we're going to look for an account called depreciation expense. So I am taking $15,000 in company asset value, reducing that and writing it off on the profit and loss statement as an expense for 2020. So we get to write off some of the value of that truck. And again, this is representing wear and tear. So as soon as I do that, I think it was like $21,000 we were showing in accumulated depreciation is going to increase by another 15. So I'm going to hit save and close it. Get back to my chart of accounts, which should have instantly updated my number. And here we go. Accumulated depreciation is now $36,000. That is me reducing the value. Let me go over to the balance sheet really quick, rerun this report. And on the chart of accounts, I'm not getting subtotals and things like that, but here I am. So as we're writing off these assets, it's little bits being ticked away every year. And eventually we will fully depreciate these assets down to zero. Because again, wear and tear, they may not have the value they did when they were first purchased. Now, where did my depreciation entry go? It left the balance sheet. And I'll jump over to the profit and loss, and we're going to look for depreciation expense. There's the $36,000 total that we've written off. And my report is showing all dates, but here's my $15,000, the debit side of that journal entry. So left the balance sheet, reduced asset value, and then we wrote it off as a business expense in 2020. And that is how you enter a depreciation entry and how it updates the balances on the financial statements and on the chart of accounts.
I started to put some of your transactions into the software. Let's look at them.
Looks fancy.
See how much more information is captured by using the software? Each transaction can include memo information, the customer or vendor it refers to, and more. All of this data can be used to run reports.
Reports?
Yeah, like the kind that tells you if your business is profitable or if you're throwing money away on unnecessary expenses. Running reports is really easy. You can choose to view all your expenses, all your income, or all your activity in one account over a certain time frame. It's also so much easier to organize, reorganize, and make sense of all the transaction data we enter.
Yay for bookkeeping in the 21st century.
No doubt about that, Lou.
Bianca, this QuickBooks thingy is awesome. You're going to be done in no time. At this rate, I'll have those financial reports for the bank by dinner.
Whoa, whoa, whoa. Lou, there is a process to things. You can't rush perfection, okay? How about you go source some new hardware for your big contract, yeah?
That's a good idea.
Now that I have Lou checking on lawnmowers, let's talk a bit more about the accounting cycle. I know we talked a little bit about this in an earlier lesson when we talked about the account equation and entering transactions into your journal and ledger. But that's just really the first part. As a new bookkeeper, the accounting cycle is also helpful because it tells you what your role is during each step. But don't take my word for it. Let's hear from an expert as they discuss the accounting cycle and its importance for new bookkeepers.
So the accounting cycle is made up of 8 major steps, and this can be massaged and modified for any individual situation. But the first thing you're going to do is identify the transactions that need to be entered. And that could be a sale or a refund or a bill from a supplier, whatever. Then the next step is to record those into your software. I mean, if you were doing it old school on ledger paper, fine, you would be doing it there on journal entries, but we're assuming you're using software. And you'd record those entries in some kind of transaction, whether it's a general journal entry or in QuickBooks, you might want to use an invoice for a sale or a sales receipt. And for purchases, you might do purchase orders or bills or what have you. So that would be the next step. So once you've posted it, the third step is to view what you've done in the general ledger, which is the entire list of accounts on the chart of accounts and the transactions that affect them one by one. Eventually, at the end of your reporting period, and let's just assume that it's a year, you'll have something called, well, you'll always have a trial balance as you go along, but you'll have at the end of the year for that, let's say it's a calendar year, January to December entries that affect that trial balance, and that's called an unadjusted trial balance. And per the accounting equation, debits equal credits in the trial balance. Then what you would do, and this is more of an accountant versus a bookkeeper, they go through the trial balance and identify what transactions have to be made as adjusting transactions. So they create worksheets for account by account, which whether it's depreciation or accruals or what have you, they'll do that. Then the adjusting journal entries are made from that trial, that worksheet. That produces the financial statements. Generally, that's the profit and loss or the income statement, as well as the balance sheet and the statement of changes in financial position and a cash flow statement as well. And lastly, you don't want somebody coming along and making changes to the period that you're hoping to finalize with those financial statements. So you would close the year. You would close the period and prevent anyone from making changes or additions or deletions to the period that you just worked on. So QuickBooks has a closing date and a closing date password feature, which is terrific. It keeps clients from getting themselves in trouble. In certain softwares that are not QuickBooks, there's actually an entry that closes out the profit and loss and dumps everything into retained earnings. QuickBooks doesn't require that. So that's pretty much the accounting cycle. The accounting cycle is basically a checklist. And checklists are very important for doing all kinds of professional work. So the thing about checklists is this. They ensure that basic critical stuff is not overlooked, while at the same time ensuring that people talk and coordinate together around common shared aims. This may not seem like something you really need to do in a simple task or simple group of tasks, but when you have some type of complexity or a problem that arises in the middle of surgery or in the middle of doing something where you're maintaining an aircraft, it's really easy for people to forget what they're supposed to be doing, the basic stuff. So checklists are a great help. When there are complications, people tend to forget what they're supposed to do because they're busy putting out fires. So as far as bookkeeping and accounting is concerned, you might have fires you have to put out with your clients, but as long as you keep the list of steps that you have to follow, whether it's day by day, week by week, month by month, year by year, then you will never let things fall off the rails because you forgot to do the basic stuff. So that's why the accounting cycle is so important. It is at the very base of it a checklist.
Now, like my father used to say, you can't make your pizza unless you start with the dough. For the accounting cycle, the first step is to gather source documents, things like receipts, invoices, bank statements. Next, you need to analyze them to figure out what is going on. In other words, what account it's impacting and whether it's a debit or a credit. After that, it's just about making a simple journal entry. We did these first two steps when we helped convert Lou's shoe boxes to financial statements. Now, the good news is that Lou is a pack rat when it comes to keeping receipts. It's what makes Lou, Lou, you know? Analyzing receipts isn't a cakewalk for everyone. It takes some time to get your head around it. Let's hear from our friend with some advice about what they look for when they're looking at source documents.
When I meet with my client for the first time, I give them a checklist. And in that checklist, I basically will have a discussion based on what they are doing. So how many accounts do they have? How many checking accounts do they have? How many credit cards accounts do they have? And then once I get all the information from them, then I go through and make sure that, first of all, I know it's this the simple step, but a lot of times people will give you bank statements and they might miss a couple of pages. They might give you 1 through 5 and you have 7 pages because they forget that sometimes they might have a reserve account or they might have a savings account that's attached to that. So it's really important that you actually go through all your bank statements to make sure, and all your credit cards, any source document that you're getting, that you have the complete source document, like it needs to be completed. You know what? That happens all the time because we have people basically working in QuickBooks or whatever accounting system that they're using, and they really don't understand. They're not accountants, which is why they need us. And so basically what happens is when we find things that are done incorrectly in the books, we basically have a teaching moment, is what I call, with that particular client. So that way they can learn as they go, because it's real important that we make sure that first thing that they trust us, right? But then also that we don't make them feel like they don't know what they're doing, even though they might not know what they're doing. But there's a way for you to basically teach your client as they go. So that way, when they're recording transactions, it's done in a proper manner.
With your journal entry in hand, the next step is to move them into the general ledger. I know we talked about this previously, so I won't spend too much time here. Remember that steps 1 and 2 happen at the same time. In other words, during a financial period, you'll want to create journal entries and post them to your ledger as soon as a transaction happens. And with software, this is even easier. Don't be like the Lou of today, keeping your receipts in a shoebox into the end of the month. Be like the Lou of tomorrow and record your transactions when they happen. I've got a friend with some good advice. Let's hear what they have to say.
The amount of time that you're going to spend on transaction will vary from client to client, since the amount of transactions and the complexity can change depending on the client's business structure, and the operating structure. Most of the time spent on transaction management is the input of categorization and transactions. It's important to ensure that these are entered correctly to save time down the road when you're having to analyze the data. Nothing is worse than spending lots of time analyzing data and finding out that it was incorrect due to a miscategorization.
Here's where the fun begins. A trial balance is the heart and soul of the accounting cycle. It's a document that lets you see all of your financial information in one place. For step 3, you'll focus on creating an unadjusted trial balance. This is what you get when you calculate all of the balances for your accounts. Think of it more as sort of a first draft. Here, let me show you an example.
So let's talk a little bit about how to manually create a trial balance with using the general ledger as a base. So I've pulled a 2020 general ledger in QuickBooks, and basically this is showing all the accounts on the chart of accounts, their beginning balance at the beginning of the period, which would have been January 1st. So the beginning balance plus all the transactions that ran through this, in this case, the checking account. So again, the general ledger is going to list all accounts on the chart of accounts for a date range and show every single transaction that went in and out of that, in this case, bank account through the year. So if I scroll down, you can see we've got a lot of activity in this. I'm gonna have to keep scrolling. This is a lot of information to just throw at somebody. So I'm gonna click down till I get to December, and I'll have an ending balance for this bank account at December 31st. So let's see what that is. Let me go up a bit. Here it is. So it's doing the running total, and the ending balance at 12/31 is 53,845. That number we're going to bring over manually to a trial balance in Excel. So we're basically crunching this down and making it so we're not seeing the details. So if we go over here, I would at December 31st would put in the company checking account and just key that right in. So let me go back. This is saying 53,845. This already has a field. Let me get my change in, 32. Put that in. Okay. So basically, I'm bringing that number across. I got an easier way to do this. Instead of me scrolling all the way down, this actually lets me collapse the activity. So now I know the savings account is 18,220. Copy that. Well, I think I copied it. Copy that. And maybe paste it there. I don't have to. The number is already there. And so I'm just going to bring all these balances over. Some accounts have a debit balance naturally, and some accounts have a credit balance naturally. So we do have a cheat sheet for you that shows you what accounts you can expect to see debit and credit balances in. Let's see if petty cash is matching up. Yep, 500. So normally bank accounts have debit balances. Debt or liabilities have credit balances. And again, you're going to just go back to general ledger and just keep pulling in the merchant account, which has a negative value. That's not good. But I would put that in the credit balance here because it's a negative asset. So basically you just key it all in, and you got to make sure that the totals are the same for each of those areas. I should point out that this goes all the way down the chart of accounts. These are cost of goods sold, income, expenses, everything. So a little bit of work to do here. Honestly, I would just pull the trial balance in QuickBooks, but that's just me.
Step 4 is all about making sure your financial statements are accurate and only include information that should be documented on this particular reporting period. If anything in your books needs to be changed, now is the time to do it. If you're worrying about knowing how to figure all that out, don't. It's the accountant or CPA that reviews the books and determines adjustments, not you. We'll tackle adjustments later. Right now, all you need to know as a bookkeeper, your role isn't deciding what adjustments need to be made. It's about entering in the new transactions and making the adjustments on the trial balance. Listen to a friend of mine explain it another way.
So when looking at adjustments in that way, whether how it should be allocated for the business, it's something that needs to be clearly identified and discussed with the client as to how those need to be allocated. It can be a little challenging because, again, you're dealing with somebody who wants to focus just on their business. They are focused on their business, and they don't want to have to deal with knowing what the adjustments are for or to that effect. And so it is helping them to understand as a whole how that is going to affect their business. If they are hands-on and want to know the minor details because it's their baby and they want to know everything about what's happening, then you walk them through each individual adjustment. There are times that they don't want to know that. They want to just move on, and you did the adjustments, you're the expert, you know what you're doing. I don't need to know the minor details. So it definitely depends on the perspective of the client. And as you build a relationship with the client, you'll get to know whether they want to know the minor details or not. But there are different situations. I've had clients that want to know every detail of every adjustment and why we're doing the adjustments. There's other people that they just want to go as an overall view, and that's it.
When you combine your unadjusted trial balance and the adjustments from your accountant, it's called an adjusted trial balance. This document is the holy grail for bookkeepers. It will tell you what you need to know about your ledger account, and without it, you wouldn't be able to get to the final step in the accounting cycle, the financial reports. Before we get to that, though, listen to a friend with a little advice about working with an adjusted trial balance.
For people just starting out with bookkeeping, that you'll hear the term trial balance, unadjusted trial balance, adjusted trial balance, adjusting journal entries. You know, what the heck is all of that? Basically, what's happening here is as you're entering all your transactions and reconciling everything all year long, let's say there's an unadjusted trial balance at the end of the year. It's basically the accumulation of all your work, but it's listing all the accounts on the chart of accounts with all the balances at year end. So basically the summary, the ending totals of all your work. Then an accountant, maybe the CPA, the CFO of the nonprofit or whoever it is going to make some adjustments to that. And usually those adjustments are some things that are non-cash, meaning like depreciation, amortization, maybe there's some accruals they need to do. It could be annually, like I'm talking about, but it could also be quarterly or monthly. So basically somebody's going to come in and draft journal entries, adjusting journal entries to get to the adjusted trial balance. So it starts with unadjusted plus journal entries equals adjusted trial balance. So they're just going to make these final last tweaks to the financials so that when they do run the profit and loss and balance sheet, it's you know, handling depreciation and all these other things that wouldn't be coming through a bank feed. So that's basically it. You're going to present the unadjusted trial balance to the tax preparer or the CPA. They're going to do some adjusting journal entries, and then you have an adjusted trial balance with the final numbers. So that's basically all it is. So my first experience working with a trial balance was actually in QuickBooks Online. When you are logged in as an accountant user, and bookkeepers are accountant users, there is a feature in the accountant tools where it's called Book to Tax. And basically, this is where the unadjusted trial balance appears. There's actually a column with all the ending numbers at the end, let's say the end of the year. And then the next column is where you would enter the adjusting journal entries. And in QuickBooks Online, if you enter a journal entry, you check a box that says adjusting, and basically it loads it to that adjusted trial balance feature. And basically the beginning unadjusted trial balance plus whatever those entries were becomes the adjusted trial balance. And that's basically the numbers that are going to get pushed over to a tax return. And in QuickBooks Online, that connects directly to ProConnect Tax Online. So it's all done in QBO. And I think it was a great experience seeing a trial balance for the first time because it's all connected right there. So if you are in QuickBooks Online accountant and you're logged into a client, take a look in the accountant tools and you'll see that feature right there, and you can kind of get a feel for what a trial balance, the adjustment, and the actual adjusted trial balance look like. So you may be wondering what your role as a bookkeeper is in preparing that initial unadjusted trial balance. And really, it's basically accumulation of all your work. You want to get, all the transactions in, clear bank feeds, reconcile, make sure everything is correct. Bank statements match the books, loan balances match the books. You're reconciling everything out on the balance sheet. All those numbers automatically appear in the unadjusted trial balance in QuickBooks Online. So an unadjusted trial balance is the fruits of your labors. It's already there. And then again, tax preparer or a CPA, somebody like that is going to look at those numbers, make their adjusting journal entries, and turn that into the adjusted trial balance, which in that case would be ready for tax prep. So you might be thinking, what should I be looking for in an adjusted trial balance? Well, I do need to say, it really depends on your scope of work as a bookkeeper. Generally, bookkeepers are handing the books over to the accountant who's doing those adjustments, and you're kind of out of the picture at that point. But maybe you're curious, maybe you want to see what's the result of their work. You could go into the adjusted trial balance area in the accountant's tools and actually see what the accountant did or whoever made those adjustments. You might be looking for things like depreciation. It would be an expense, depreciation expense, but also reducing the value of that asset on the balance sheet. Those accruals like that, maybe they're accruing payroll at year end. You might see a payroll accrual adjustment. So again, probably not in a startup bookkeeper scope of work, but it's very important to know what it is and what's going on using the trial balance tool.
Now, don't get angry with me, but I've got something for you. I was going through some other stuff and I found another shoebox full of receipts and stuff.
Lou? Are you kidding me? How do you have so many shoeboxes? I've only ever seen you wear one pair of boots. All right, give me the box and I'll get these entered. But promise me, no more surprises, all right? Good thing we're using QuickBooks and not doing this by hand. Let's take a look at a few of these and see what we have. Okay, we have a couple of sales receipts, some deposits. This would be a credit memo, and this looks like a check Lou wrote to a vendor. Let's start with these sales receipts. They're pretty straightforward. You make a sale or do a job, you get paid. Boom, sales receipt. With a manual process, you would have to debit this and credit that. But not here. With QuickBooks, you enter it once, and you're done. Take a look.
Let's go over how to create a sales receipt in QuickBooks. We'll also show you how to use the undeposited funds account, so you can group transactions together into a single deposit to match your bank records. Note that if a customer pays for their purchase right away, you record a sales receipt. But if they're going to pay you later, then you create an invoice. We'll go over that in a separate video. To start, go to the New menu and select Sales Receipt. Customer information is optional on a sales receipt, but if you want to track your sales by customer, you should enter it. The date of the sale defaults to today, but you can change it if the sale happened on another day. For payment method, choose how your customer paid you. If you want to add a new payment type, you can select Add New. If you want to process a credit card payment using QuickBooks Payments, check out our link at the end of the video. For this example, we'll select cash, but if we got paid with a check, we can record the check number. Next, tell QuickBooks where you're going to deposit the money. For this example, we'll select Undeposited Funds. Undeposited funds is a temporary account that holds payments you plan to deposit later at the bank. It lets you easily combine several payments together into a single bank deposit. However, if you're going to deposit this payment into the bank as a single transaction, then you can skip this and just select Checking. Next, in the Products and Services area, enter what you sold your customer. If you already set up the product in QuickBooks, you'll see the description and amount you entered earlier. You can also enter or change these while you create the receipt. If you haven't entered this item yet, select Add New and enter it here. Choose everything that's included in this sale. Once you're done, select Save and Send if you want to send the customer a receipt, or one of the other save options if you don't. You'll see your customer's receipt here. You can change the subject line and the body of the email that gets sent to your customer. Select Send and Close when you're ready to send the receipt. Now you're ready to create your own sales receipt.
I see you finished up those sales receipts, and it's looking good. Let's move on.
So how's my favorite bookkeeper doing?
I'm surrounded by shoeboxes. What's up?
Just wanted to let you know that I deposited those 2 checks. By the way, any idea when I can get those financial reports?
Lou, I'm up to my eyeballs in sales receipts and invoices over here. Forget about it.
Sales receipts and invoices. Aren't those the same thing?
Oh, Lou. You know, most small business owners treat every sales transaction the same. Customer pays in cash, sales receipt. Send an invoice, sales receipt. This is actually pretty common. However, when it comes to bookkeeping, doing this is a huge mistake. If you enter everything as a sales receipt, how are you going to keep track of who owes you what? That's why it's so important to log things correctly. Here, let me show you this video. It will explain the difference.
When recording sales into QuickBooks, there are two primary workflows. With the first workflow, customers have a number of days to pay. There's also a second workflow, though, which is if a customer pays at the time of the sale. Now, with the first workflow, with the customers having a number of days to pay, the first transaction you enter is an invoice. Then later, they give you a payment, and that payment gets applied to the invoice in the form of a receive payment transaction. It's something that you need to enter into QuickBooks. If the money goes directly into checking, you're done. There's no other transactions to enter. But if the payment is going to be deposited at the bank later or grouped together with other customer payments, there is one final transaction that needs to be made, which is a bank deposit. So that is the first workflow, if a customer is given a number of days to pay. If, however, a customer pays right away, the first transaction that you need to enter is a sales receipt. A sales receipt tells QuickBooks not only did you make a sale, but you also received money from a customer. Because the sales receipt combines both the sale and the receipt of money, you're able to skip the receive payment step and go directly over to the bank deposit. Use these two workflows to record your sales in QuickBooks.
Moving right along. Lou mentioned that he finally got around to depositing those checks. Now that they are finally in the bank, we need to move the transaction into his bank account. That way we know where the money is and it isn't hanging out in limbo. Let's take a look at how to do that in QuickBooks.
The final step in the sales process is to record your bank deposit. We'll go over how to do this using the undeposited funds account. This lets you group multiple customer payments together into a single bank deposit. However, this step is not necessary if you already deposited the funds directly into your bank account in QuickBooks during the receive payment process. Let's open the chart of accounts and look for undeposited funds. You're going to move this balance from undeposited funds into your bank account to match your actual bank deposit. If you want to know how payments get into undeposited funds, we cover that in our videos on how to record an invoice payment and how to record a sales receipt. The balance in this account is $125. To record the deposit, select New and then Bank Deposit. Choose the bank account that you're depositing the money to. You can see your current balance with that bank account, and you can enter the date that the deposit took place. QuickBooks shows all the transactions from your undeposited funds account. You'll notice the total matches what you saw in the chart of accounts. Here we have check number 987, and then some cash in the amount of $75 given to us by a second customer. We're depositing both payments at the bank, so I'll add a check mark next to each transaction. Now we see that the total deposit is $125. If you're depositing any extra money along with these customer payments, you can include any additional deposits in this section. The key to this entire process is making sure that your deposit in QuickBooks is for the exact same amount as the deposit you see on your bank statement. To complete the process, select Save and Close. Now, in the chart of accounts, undeposited funds has gone down to zero, and the $125 balance moved into checking. Now, try recording a bank deposit of your own.
Let's see what else Lou has got in this shoebox of his. Here's another receipt. It looks like Lou had repairs done on some equipment of his and paid with a check. You know, I got a cousin who makes a killing off fixing small engines. I should give Lou his number. When a business pays someone else, like a vendor, we call it money out. Let's take a look at how to log this type of transaction using QuickBooks.
If you make a purchase using a handwritten check, or if you want QuickBooks Online to print the check for you, you need to enter a check in QuickBooks. We'll show you how to record a check and how to print it out right from QuickBooks. To start, go to New and then Check. First, enter the payee, which is who you're paying with the check. You can choose from a list of people who are already in QuickBooks, or you can select Add New to add someone. We're going to pay our electric bill. Then select the bank account the money will come from. You can see the balance that QuickBooks has for that account here. Fill in the correct payment date for the check. If you are printing a check, that will usually be today. If you are recording a handwritten check, change this to the date that you wrote the check. Then record the check number here. If you want to print this check out later, select this box. This enters the check into the print queue, where you can print it either by itself or in a batch with other checks. You'll assign the check number when you print the check later. If you want to order checks from QuickBooks, you can do that here. Under Category, tell QuickBooks the reason you're writing the check. In our case, we're writing a check for utilities. In the description, you can enter a more detailed description of why you're spending this money. In the Amount field, enter the amount of money you're spending. Now, save and close. This records the check in QuickBooks. If you just need to record a handwritten check that you already wrote, then you're done. Now, to print your check, select New and then Print Checks to view your print queue. If you are printing checks for the first time, you'll see some instructions on how to get set up for printing checks and how to print a sample. Once you are finished setting up, go back to your print queue to print your checks. Your print queue shows all the checks you wanted to print later. Here's the check we just created. Select the checks you want to print and then select Preview and Print. QuickBooks opens the print window. Select Print to print the checks. Afterward, you can confirm whether or not they printed correctly. If not, you can reprint them. When the check is cashed at a later date, you'll need to match that bank transaction with a check you just recorded. At the end of this video, we have links to videos to show you how to do this when your bank account is connected to QuickBooks, and how to do it manually. Now you're ready to record and print your own checks in QuickBooks.
Wow, we are making progress. One more transaction and another shoebox down. Let's see what's left. Here's a good one. It looks like a frequent customer paid for a job, but then canceled last minute. Rather than giving the customer a refund, Lou just applied the amount to the next job, just like a store credit. This is called a credit memo, and it's a pretty simple process when using QuickBooks. Take a look.
This is Mark from the QuickBooks team. You can easily issue credit to your customers in QuickBooks Online. You might want to do this because you need to reduce a customer's invoice for some reason, or you might want to give a customer credit because they're a good customer. Note the difference between credit and a refund is a refund happens when you need to send money back to a customer. A credit is when you want to reduce what they owe you, either now or in the future. To give customers credit, you'll create a credit memo. Let's go over how to create a credit memo, send it to a customer, and then apply that credit to an invoice. To start, select New and Credit Memo, or Give Credit, depending on your view. Select the customer you want to give credit to. Then select the products and services you want to give them credit for. Then the amount of the credit you want to give them. You can also select Plus Add New and create a credit item that doesn't have a specific price. Anytime you add it to a credit memo, you can fill in the amount you want to credit your customer's account. If you want to send a copy of the credit to your customer, select Save and Send. Otherwise, you can select another Save option so QuickBooks records the credit. We'll select Save and Send for this option. You see the PDF version of the credit memo that your customer will receive here. If everything looks good, select Save and Close, and your credit memo is on its way. Now let's go over how to apply a credit memo to an invoice. If your customer already has an open invoice with you, then this happens automatically. To see this, go to your customer list, find your customer and the open invoice. Select it, and you can see QuickBooks has applied the credit memo to the open invoice. What happened is QuickBooks automatically created this payment transaction here to apply the credit memo to the oldest open invoice. However, if your customer has multiple open invoices and you want to apply this credit to a different one, just select the payment. Then select the invoice you want to apply it to and enter the amount. Make sure this matches the amount of the credit memo. Once everything looks good, save and then confirm. If your customer doesn't have an open invoice, then the credit will automatically be applied to their next invoice. Let's take a look. Just create a credit memo for your customer. Then, when you create a new invoice for your customer, you will see that QuickBooks has applied the credit to your new invoice. That's it. Now you can create credit memos for your own customers.
Oh, Lou, come see, I have a surprise for you. I've got everything entered and organized. What do you think? We're just about ready to get those financial reports you were looking for.
Huh? Hey, yeah, that's great.
Lou, are you listening to me?
Yeah, I got you. Just throwing out some old junk mail.
Wait, what? What are you tossing out there?
Nothing, just an old bank statement.
Ugh, Lou! We need that. These are the kinds of things we'll use to make adjustments. I can't believe you were going to toss these bank statements. What do we have here? Checking account? Business credit card? Vehicle loan? This is bookkeeping gold.
But I thought you already got all that transaction information from the receipts in the shoeboxes.
Sometimes there's information we need to record that isn't on a receipt. The shoebox receipts were enough to calculate the adjusted trial balances, but I have a feeling we might need to make an adjusting entry or two.
I'm starting to realize there's a lot I don't know about bookkeeping.
Forget about it. That's why I'm here. Let me pull out the adjusted trial balance I calculated.
The role of the bookkeeper when it comes to making adjustments. Generally speaking, we're talking about the adjusting journal entries at the end of a fiscal year. In that case, your client will have had the accountant go through their books and produce the financials and the final trial balance. But you want to make sure that the adjustments that they deem necessary to enter are indeed entered in the accounting software. If the accountant is rather hands-off when it comes to QuickBooks, then they'll just give you a list of entries and you will make them and mark them as adjusting. And then, of course, you'll double check to make sure that your final or adjusted trial balance syncs with the accountant's.
All right. I took a look at Lou's bank statements and figured out how much interest he'll need to add as an adjustment. I've also created the proper entries in the journal and ledger. The next step is to create an adjusted trial balance, which is pretty much a revised and more accurate version of the unadjusted trial balance. First, we need to look at the journal and ledger to make sure that the adjusted entry has been added. It will usually be marked in a way that tells you which accounts were affected by the transaction and by how much. Next, using our unadjusted trial balance as a starting point, factor in the amounts for the adjustments to their corresponding accounts. Finally, in your adjusted trial balance, you'll need to determine the new amounts for each section. Once the amounts are tallied and you've reviewed it to make sure that both the credits and debits balance, you've officially created your adjusted trial balance. Does that make sense? There's only one way to find out. Give it a shot. With the adjusted trial balance in hand, we can produce those important financial statements Lou needs. Once the statements are produced, you can close the books and the cycle starts all over for next month. It's like saying goodbye to the previous accounting period and a big hello to the new one.
So when we've finished all of our work, we've reconciled a period, we've got all the reports looking and running the way we want, then it's time to close the books. Basically, we are protecting the books from being changed. And it's really important because I do this all the time. When the year ticks over to the new year, I still type in the prior year for probably a month. And sometimes I close the books right away just to protect the books from myself. It's just I key things in with the wrong year for a little bit. It just happens. So closing the books in QuickBooks Online is really easy. It's actually a setting, and I'll show you how to do that right now. You go up to the gear and you go to Account and Settings right here. And on the left side of Account and Settings, you can make that change. I'll go to the Advanced tab, and right here there's a feature that says Close the Books. Right now these books are not closed. So we finished all the accounting, everything looks good. I'm going to turn that feature on. I'm going to put in 12/31 of 20. So I'm locking the books up to that moment in time. So if anybody tries to make a change, they have to go through some steps. So basically we want to lock them down. We don't want any unauthorized changes. Your two options are allow the change with just a warning, hey, the books are closed. My experience, my clients never read those warnings anyway. They just click right through them. So if it was a client that's like that, I may not choose that one. I would do a warning, and then if it's really something that needs to be entered, like maybe it is depreciation, we want to enter a password to allow that last entry to go in. So you could enter a password. So then just go in here and choose a password, and don't forget it, right? Oh, I typed it in wrong. That should work. And then hit save. So these books are closed. Basically, what's going to happen is, oops, that was weird. Let me get rid of this. So these books are closed. So basically what's going to happen if anybody who's a user of QuickBooks is going to log in and try and make a change to anything from dated 12/31/20 or past, they are going to be prompted with that password. So let me just try to enter something. I'm going to enter a new expense. And I love this because it just kind of locks things down, right? I decide we want to put something in here again. I'll do office supplies again. Close that. And 1,500. But this time I'm backdating it to 12/31 or any time period earlier, and I hit save. Double check the date. If I'm okay with this entry, we forgot to enter something. Well, enter the password, and it allows it. So let's go ahead and enter an expense, and we'll backdate it to the close period. So I'll put in Office Supply Center, date 12/31/20, put in office supplies here, paying out $1,500, and we'll go ahead and hit save and close. And I have to enter the password. So again, if you don't want to share this password with people who don't have authorization to make changes to history. So the only time you would really want to make a change is something like depreciation or some closing or adjusting entries at year end. Generally, you're not supposed to go change an accounting period you've already reported on. So key in the password, hit yes, and you're able to make that entry. So back in the good old days, bookkeeping was literally books. There was giant ledger books that you would write debits and credits and columns and total things, and that's where the word bookkeeping came to play. That's how the name came there. And we really don't really use books anymore. So when it comes to the term closing the books, basically all year long, you've been filling in all these columns and rows and totaling page after page and bringing the total to the next page. At the end of the year, you literally close the book and you take that book and throw it up on the shelf. Books are closed, no more changes. That's what it means.
You may have noticed I glossed over the whole financial statement steps a bit there. That's because it's a big topic. Let me grab another cup of coffee, and then I'll be ready to take that up with you. Today is the day, Lou. We're ready to produce those long-awaited financial statements.
Yeah, I can smell that new lawnmower smell now.
Slow your roll, Lou. We don't know that your loan will get approved, but we do know up-to-date financial statements are your best shot.
Great. I can't wait to see how much money is coming in.
Each report only shows you a piece of the puzzle. You'll need to look at all the reports together to get a feel for how your company is doing.
Okay.
Here we go. Don't get me wrong, our adjusted trial balance provides valuable information, but it's a little hard to read and interpret, especially if you want to see changes in the finances over time. That's why accountants devise different financial statements, which take information from the trial balance and put it in a more readable format. Trust me, clients and other stakeholders want nice, organized reports and statements to look at. The trial balance view is for us bookkeeping superheroes. To create a full financial picture of Lou's Lawn Care, we'll produce 4 financial statements and explore how they relate to each other. Come on, let's get this show on the road. First, let's take a look at the balance sheet. Previously, you mastered the equation assets equal liabilities plus equity. This is the foundation of a balance sheet. Now, I like viewing my balance sheet with the assets on the left, liabilities and equity on the right. But when using accounting software, you'll likely see it as one long list. Here's an overview of the balance sheet in QuickBooks Online.
The balance sheet is used to track all of the assets, liabilities, and equity of a business. You can access the balance sheet by clicking Reports over on the left nav bar, and then Balance Sheet underneath Favorites. The balance sheet displays what the business owns and what the business owes as of a single day. This can be seen as a snapshot of your business. The first section of the balance sheet are the company's assets. This is what the business owns. First, you can see the business's bank accounts, followed by accounts receivable. This is a record of what your customers currently owe you. There are also other current assets. These are assets that you plan on selling within 1 year. And then finally, fixed assets. These are large purchases that a business uses over the course of several years. Scrolling down, the second section of the balance sheet is liabilities and equity. This is a measure of what the business owes. The first section of liabilities and equity is liabilities. This is what the business owes to people outside of the business. First is accounts payable. This is what the business currently owes on open bills, followed by credit cards. Then other current liabilities like lines of credit. And then finally long-term liabilities, which are larger loans that take several years to pay, like small business loans or car notes. The final portion of a balance sheet is equity. This is what the business owes to the owners. Essentially, this is the value of the business from the point of view of the people that own the business. The basic accounting equation at the heart of the balance sheet is assets equal liabilities plus equity. So basically, if we took everything that the business currently owns, so all of the assets worth $52,234.96, sold it all off, the first people that we would have to pay off are people outside of the business. So we would pay them $18,068.27. Then the money that we have left over after we pay off all of our vendors and creditors is what the business is worth to the owner, $34,166.69, and that's what you would get to keep. Monitoring your balance sheet on a regular basis is integral to maintaining the health of your business.
So, now you know what a balance sheet is, but how does it actually work? Day 1. You have just created your own graphic design firm. On the first day, you deposit $5,000 into the business bank account. Later that day, $50 is withdrawn and deposited into petty cash. On the balance sheet, the amount in the bank account is listed as $4,950, and the amount in petty cash is listed as $50, which makes the current assets and equity $5,000. Day 2. On the next day, you buy $2,000 worth of posters to sell. You now have $2,950 left in your bank account and $2,000 in inventory. Day 3. The following day, you take $500 in posters and sell these posters at a local concert for $650, making a profit of $150. Afterward, you deposit these funds. Your bank account increases to $3,600. The amount in your inventory decreases to $1,500, and your current earnings increase to $150. Day 4. On the 4th day, you decide to buy a van to get to concerts more easily. You are able to take out a loan and buy the van for $4,500, which will be paid over 3 years. On your balance sheet, the vehicle value of $4,500 is listed under fixed assets, and $4,500 is also added to long-term liability, since it will take longer than 12 months to pay off. Day 5. On this day, you buy a graphic printer for $1,800. You are able to open an account with a company, so you don't have to pay for it all right away. But you do have to pay in full by the end of the month. This increases your fixed assets by $1,800, but also adds $1,800 to your current liabilities, since it will need to be paid off within 12 months. Using the equation assets equal liabilities plus equity, we can see that your sheet is balanced, with a total of $11,450 on both sides.
And this actually shows up on the balance sheet and I'll just go ahead and open a balance sheet. I'm going to open the report center. I'm right-clicking to open it in a new browser tab, so I don't have to leave my chart of accounts up here. So I still have the chart of accounts open on this tab, and now I'm going to open the report center, and I'll just show you that the order of the chart of accounts actually mirrors on the balance sheet over here. So bank accounts at the top, current assets here, totaling, it's giving me subtotals now. So now if I added up all my cash, everything the company owns, they've got 251 grand in stuff they own, right? As soon as we get past the fixed assets, we start showing the debt, which is liabilities on the balance sheet. We got accounts payable, credit cards, other loans like the PPP loan, let's say. Total liabilities is 625. And if you think about it, this is more than what they own. So they have a lot of debt at this company, right? The difference being their equity in the company. They liquidated today, sold all their assets and paid off everything, they'd still be in debt. So if you look, total equity is a negative 373,000. So this is kind of showing the value of the business if it was going to be liquidated today. Not good, right? So the chart of accounts actually mirrors here. One other thing I should mention, the next part of the chart of accounts after the equity accounts are income. You see them here, income, cost of goods sold, expenses. What financial statement is that? Well, let's open the tab again. New tab, I'm going here, and we're going to open the profit and loss statement. Same order. So the profit and loss, whoa, let me get down there. Profit and loss is going to show income, costs, and then subtotal it, right? Cost of goods sold, I got a subtotal there, and then all the expenses down here. That's a lot of expenses. Here we go. So basically you take income, you subtract cost of goods sold and expenses, you're going to get this net income, the bottom line. This company during this period that we're looking at losing money. Okay. So basically the chart of accounts is the balance sheet at the top and the profit and loss statement at the bottom. And as you are entering transactions, you are changing these numbers. So let's say I write a check. I'll just do one really quick. I'm going to write a check out of the checking account. And you choose the source bank account. So this is going to come out of company checking. And pull a payee in here. Let's say I'm paying the supply store. I do have bills or a purchase order. I'm not going to acknowledge that right now. And I'm going to put this to office supplies. And we're going to buy $1,500 worth of something and book it to office supplies. Okay, so basically I'm taking $1,500 out of this checking account, and QuickBooks is showing me the balance. If I go to the balance sheet, I should have that same, oh, this is as of last year. Let's through today. I'll just do all dates. Okay, so this is $68,996 on the balance sheet. On my check, I'm getting the same number, and I'm about to take $1,500 out of there, and I'm moving it to this category, office supplies. So I'm going to hit save and close. Says I'm duplicating a check number. I'm not going to worry about that. And now my bank balance, all dates, run that report, and I'll scroll down to office supplies, which is right here. Click on the number, and here's my $1,500 check. So I took money off the balance sheet in the cash account, reduced cash available, spent it on office supplies, which then hit the profit and loss. And the chart of accounts ties all of that together. So now you know why it's in the order it's in and how we're moving money up and down this list of accounts to get those final numbers.
Something else important, especially for someone like Lou, is the income statement, also known as the profit and loss report. Why is this important? Because it can help keep you on the straight and narrow when dealing with any taxes you owe. I don't know about you, but there's nothing I'd like more than to look at how to read and use an income statement right now. As you may have guessed, accounting software can create a profit and loss statement for you with a click of a button. Here's an overview of that process in QuickBooks Online.
The profit and loss statement shows you your business's income and expenses over a period of time. You can access your profit and loss statement by selecting Reports from the nav bar on the left and then clicking Profit and Loss underneath Favorites. The profit and loss statement shows you how much money your business made and spent over the displayed period of time. At the top of the profit and loss statement, you see your business's income displayed right here, divided up into different income accounts so you can see your general revenue streams. Right here you also see your cost of goods sold. These are costs specifically for the production of goods that you sold or services that you charged your customers for. And then towards the bottom of the profit and loss are your expenses. These are expenses for the general maintenance of your business, such as advertising, insurance, rent, and utilities. The profit and loss statement allows you to see your total income minus your cost of goods sold, and then also minus your expenses to display your net income. This is your profit over the selected period of time. Let's take a look at the balance sheet by going to Reports and then Balance Sheet. Now, let's scroll down to the bottom of the balance sheet to the Equity section. Here we can see the exact same number that was displayed on the profit and loss statement before. So the end result of the profit and loss statement is also displayed on the balance sheet. And the net income, or profit of a business, is used to calculate the growth in what the business is worth to the owner because it's in the Equity section of the balance sheet. Use the profit and loss statement to measure the basic profitability of your business.
Income statements are a bookkeeper's basic. Without one, you won't know what is going on with a company financially. Let me get my good friend, who is an absolute expert, to spill all their advice on how to use these income statements.
It can be definitely used to gauge where the company is. It shows how much you've made. It can be something that as easy as your expenses and what you've made in money, what money you've brought in. So an income statement, can be used for loans for a business, or it can be something as simple as, I just need to know where my company is. As I've worked with various entities, various service companies, One in particular, he's a DJ, and he wanted to know where his company stood, especially with all that happened last year with the pandemic. He lost some income, but he wanted to make sure that he had come ahead because he had some good projects that he worked on, even in the midst of that. And so he was able to see what he had made as a company and what expenses he had. So in fact, he thought he had lost some money, but with looking at the income statement, I was able to show him how he had turned a profit, actually, even through all that craziness. And he was able to find some projects, some weddings, even remotely to do them. He did come out ahead.
The next statement is a doozy. It can show you how equity has grown or shrunk over time. It's called the Statement of Equity. Let's take a closer look. Say you want to see how your equity has changed over the past year. When you began the year, you had $100,000 in capital. This is your beginning balance. Over a year, you made additional contributions to the business totaling $10,000, and you had an ending net income of $57,000. Not too shabby, if I do say so. Because this is considered income, and income increases total capital, you would add these amounts to the original amount, giving you a total of $167,000. But withdrawals also decrease capital, so we'll have to make sure to factor that in to get an accurate ending balance. Let's assume that over the year, you withdrew $20,000. You'll need to deduct this amount from the previous income total. This ultimately gives you the capital balance, or the amount of equity that has either increased or decreased over the reporting period, in this case, a year. A small business like Lou's may have a stellar net profit, but it may be lacking dollars in the bank. This can be confusing because the cash in the bank isn't the real story. Cash in an account does not reflect profit. So what does? I'm glad you asked. The answer is the statement of cash flow. The statement of cash flow looks at the totals from the balance sheet and the income statement to paint a picture of where money is flowing. That's why it's called a cash flow statement, get it? Through your business. Checking the statement monthly is important. If you don't, it can hurt your gig. When you do, it can help you decide what operating costs to adjust so you stay in the black. What's that? You want to know how it works? I knew you were going to ask that, so I've already prepared an exercise for you. Let's assume you have already completed your income statement and the balance sheet for the beginning and end of the month. According to your income statement, you had a net income of $200. At the beginning of the month, you had $100 reported as cash on your balance sheet. But you ended the month with negative $100 in the cash account. How could that be if you made a net profit of $200? You gotta start with your starting cash. This is the money you had in your bank account at the beginning of the month. In this case, it's $100. Next, add what you made in net income, $200. If we stop here, it will look like you should have $300 in your account. But that isn't the reality, is it? The next step is to factor in other changes to your assets and liabilities. Depending on the complexities of your business, this could be quite a few items. But for this scenario, just assume that your accounts receivable, or the account that tracks the amount of money owed to you, is the only change, and that it has increased from $0 to $400. You would subtract this increase since it is money that you haven't collected yet. When all is said and done, you should end up with the ending cash balance of negative $100, which matches what was listed in your balance sheet. So now you are wondering, how do these statements work together, aren't you? Try to think of each of these statements as a piece in a puzzle. In this case, it's a financial puzzle for a business. Each piece shows only a small part of the picture. For example, the balance sheet might give you a snapshot of the equity for a given reporting period, but it doesn't show how that equity has changed. At the same time, the income statement might give you the net income, but it doesn't tell you how the money has been moving throughout the business. Stay with me here. In order to see the complete picture, each piece needs to connect and work with the others. Only then can a business owner really get a sense of the financial health of their business. Well, Lou, here you go. Remember when we met? You didn't want anything to do with me or my bookkeeping. And now look at you, ready to present organized financial statements to the bank. Don't mess this up. I'll be back to check in on you soon. In the meantime, I wish you the best. So if you thought for a second I was just going to sit around here and twiddle my thumbs until it's time to check on Lou, then you got me all wrong. Oh no, now I got too focused on my side hustle.
Bianca's Bookkeeping Bootcamp, where we take you from basic to boss, coming to a city near you. Learn important topics like key assumptions and principles of accounting, the periodicity assumption, accrual versus cash basis accounting, and more. Hurry, sign up today. Only a few spots left.
You're one of the best interns I've ever had. So smart, so thoughtful, so good at staying out of my jelly bean jar. Anyway, I have a special gift for you. A paid-in-full Bianca's Bookkeeping Bootcamp experience. You might have to work a little, too. I'm so glad you decided to take your bookkeeping skills from basic to boss with me, Bianca, from Bookkeeping Rescue. Let's get to it, all right? So, I know some of you are really new to the field and some of you have a bit of experience. I want us to all be on the same page about some things. In any profession, there are some key assumptions about how things work. For instance, a fast food worker assumes that when she places orders, other team members are filling those orders and the order will be ready for the customer at the pickup window. After a while, it just becomes second nature to assume that's how things are supposed to work. Let's hear from one of my favorite bookkeeping bootcamp grads on the matter.
Key assumptions are important in accounting because they are the building block of where you start as an accountant. You can measure your books based on the assumption. There's times that you have to assume what's going to happen in the next year. And then there's times that you have to assume how much revenue you could possibly make and potentially make. There's times you have to assume how many bills you might have to make or have to have. So it is all an assumption in that aspect. They are important and you have to know the guidelines of how to reach those assumptions. If you do not do the assumptions the proper and appropriate way, it can give you a skewed report of your business and how it could look. There could be potentially really a tragic end of a business because the assumptions were incorrect. I think back to last year in March 2020, nobody could have assumed what was going to happen for the rest of the year. And so businesses failed, and so that could potentially be what happens if the assumptions are done incorrectly.
You did great! Now drop and give me 10 examples of debits and credits. I'm going to take a few minutes to get my mind right for the next session on the wonderful world of periodicity. See you after this ad from our sponsor, Ready Steady Jobs.
I struggled for years to find good bookkeepers to hire at my job until I created a plan for them to find great places to work so they would find me. Hi, I'm Mary O'Donnell, and my company, Ready, Steady, Get Jobs, wants to help you find the bookkeeping job of your dreams. Get my exclusive 4-step guide to understanding the job search timeline, track your job search, getting interviews, passing interviews. Click here to get yours today and tell them Mary sent you.
Welcome back to the Bookkeeping Bootcamp, where new bookkeepers go from basic to boss. Now, for a variety of reasons, businesses need to look at their financial report to make decisions. Problem is, they can't wait until the end of the year to know what's going on with their money. Seriously, nobody's got that kind of time. Today, we're going to kick things off with a quick talk about the periodicity assumption and its implications. I know that's a real mouthful, but it's one of those things that plays a large role in your life as a bookkeeper. Let's get started. In a nutshell, the periodicity assumption, otherwise known as the time period assumption, basically means that as a bookkeeper, you can report a company's financials in smaller chunks of time, like annually, quarterly, or even monthly. Think of a company's financial life like a straw. On one end is where the company started. On the other, the point where the business would end. Now, because a company's business activity is fluid, money coming in, money going out, it would flow through the straw like water. Now, from an accounting standpoint, looking at the entire financial life cycle of a company doesn't do us any good. So, we use the periodicity assumption to cut this straw into smaller pieces so we can look at what's going on at that particular period of time. In order for your clients to run a successful business, they need to know what is happening with their money. To do that, they need timely information. They can't wait until December to learn they're in a position to buy a new piece of equipment that they needed for a job back in March. Think of it like a puzzle. If you're just looking at the big picture, you aren't really seeing how all those little pieces are connected and working together. Let's hear from another of my STAR Bookkeeping Bootcamp graduates.
Well, the biggest thing that we want to make sure that clients do is have reports that they understand. So not only the categories that they're in, but also the periods that we're looking at. So it really is important to understand what that looks like for that particular client. Is it month-to-month comparisons for the last 12 months, even if it's through the middle of their fiscal year to last year or whatever? Also, it could be quarterly. So we have some clients that budget quarterly because that makes more sense for them. So what we want to do is understand how they're looking at things in their business and then run reports to match that. So we often will talk about how would you like to categorize things in your chart of accounts, and they don't have any idea. But I say, how would you look at these numbers based on a budget? And then they're like, oh, well, we want to be able to see it by this and this and this. I'm like, awesome. Let's get your chart of accounts mapping that way. And then the next question is, and what periods do you look at? So do you look at it by month? Would it help you to see it month to month or quarter to quarter? We always want to look at it year over year, things like that. So we really try to understand how the business owner runs their business, how they look at their numbers, what are the important things that they're trying to get from it, and then match the reports to it. One other example would be, for example, a business owner who needs to do quarterly tax payments. So while they might not, from an operations standpoint, look at it by quarter, maybe they look at that by month, but periodically we need to run it by quarter. They then can take that to their tax planner, who would then be able to see how they're doing in that quarter to be able to understand what they're going to do as far as tax estimates are concerned. So those are the types of things that we do. But again, it's about understanding your client, what their needs are, and then having those reports match to that so that they can make better decisions or whatever it is they need to do.
In the bookkeeping world, there's a little something called the revenue recognition principle. In simple terms, the principle means that a business only recognizes money once the good or service has been provided to the customer. In other words, if you haven't done the job, you haven't earned the money. Here's a grad to tell you more.
Subscriptions. So if I were to pay for, if I were to pay a digital app company, I would pay whatever it is, $500 for a 5-year license to whatever. They're not going to recognize that $500 right away. They're going to split it up as they earn it. So it's really important not to, even if even though they got that $500 right away, they'll put that into deferred revenue or unearned revenue. And then year by year or month by month, they will chip away at that deferred revenue and recognize it as real sales. I have had clients come to me where it's been such a dog's breakfast and it's so laborious and onerous to figure out how much deferred revenue to take away and recognize revenue every month, because they were selling different terms of subscriptions to different people or different businesses at different rates. And so they had this crazy spreadsheet which everybody relied upon, and it still required a lot of work at the end of the month. What I ended up doing with them was suggesting or recommending apps that work with QuickBooks that deal with deferred revenue and revenue recognition of subscriptions. So if a client was not recognizing revenue correctly, I don't even know how to answer that. What would be the repercussions that they may face? Well, one of the things that they could face is that if they ever get audited by the IRS or whatever, and they go through their schedules of deferred revenue and their method for amortizing it, let's say, and recognizing it into revenue, if they ever got audited, they could have penalties and interest, and they would be have a reassessment of their taxes, and it could be really messy and costly. On a smaller scale, if they weren't audited by the government, and they are not doing a great job at recognizing the revenue, all kinds of things could get messed up. They wouldn't know. They wouldn't have a clear picture of what their profitability is from period to period, and they might even mess up on when to approach their clients or customers for renewals of their contracts. They could actually lose money. If I did have this one client, actually, I had this one client that was a concierge, and what they did was they sold. This is generally, their clientele was wealthy people, and they sold hours of work in blocks of 50 hours. And they needed to know when the 50 hours was almost up, so that they could reach out to their clients and say, hey, your block of 50 hours is almost used up. Wouldn't you like to renew with us, blah, blah, blah. So they really, if they were to mess up on the deferred revenue being recognized as real revenue, sure, their profit and loss would be messed up. So they wouldn't know, for instance, which clients, if they were doing job costing, they wouldn't know which clients were profitable clients and which ones to stop doing business with, or if maybe they should change their prices. So they wouldn't know that. Plus, they actually ran the risk of giving away hours for free after the 50 hours were used up. And then they'd find out after the fact, whoops, we've been giving that, they didn't pay us for another block of 50. And then they've got to now chase after these people to pay them. So yeah, they run a whole bunch of risks.
Take our friend Lou. Let's say that he did a job for somebody and sent them an invoice, but the guy didn't pay until the monthly financial report was run. In this case, because Lou did the job during the reporting period, he would recognize that money as being earned on his books. At the same time, though, if Lou had a customer that paid in advance, that money would be classified as unearned revenue until he performed the job. This is what we in the biz call deferred revenue. Now, with accounting software like QuickBooks, this whole revenue recognition thing is pretty easy. Let's take a look.
So now we're going to enter an invoice and show the changes to accounts receivable on our balance sheet. So what I'm going to do is go to the new and invoice. QuickBooks Online assumes if you're using an invoice, it's going to affect accounts receivable automatically as soon as you hit save. So you just pull in a customer name, pull in a product you're selling. Let's just do the drop down and sell some books here. And let's do 5 of those. All right, so it's totaling my invoice at $232.50. Let me get my date correct. I'm gonna do today's date. Let's say it's February 4th, and we're gonna hit save. Now, before I do that, I wanted to see what my balance is on the balance sheet. So I have a balance sheet open in another tab. I have it set to all dates, and here is my accounts receivable. And QuickBooks is going to know to affect accounts receivable for the $232.50. I'm going to hit save. Go over to outside the box and on this one on the balance sheet and click run report. And it has updated the balance in accounts receivable. What else has it done? Well, I'll go back to my invoice because there must be a double entry here. I've affected accounts receivable, and I've also affected another account. If you look, I have a product here called Books for Resale, but I don't see what account, what type of income that's affecting. There is a trick in QuickBooks Online. If you go to the More button on a saved transaction, you can go to the transaction journal. This is basically going to show you the debits and the credits on this particular invoice. So I'll open that report up. And then we can see what income account was affected with our invoice. Looks to me like product book sales got the credit of $232.50. So every time you hit save on a transaction in QuickBooks, you can actually open that transaction journal and see the debits and credits in the background. So if I go to this revenue account on the profit and loss, and I'll update the report first. And there should be a book sales revenue. My invoice should be in here. It's one of these. It's February 4th. There it is. Let me scroll over and you can see my $232.50. So QuickBooks knows what to do already in the background. And this is the transaction journal. It's a really powerful tool if you ever want to take a look at the debits and credits hiding behind a transaction.
A business's activity is fluid, like water, which means you can't have revenue without taking on some expenses. And business activity doesn't stop just because the year ends. Because of that, we have a handy-dandy matching principle. This thing's great. It means when a business earns revenue, money, during a reporting period, all expenses spent during the same reporting period should be matched up and factored into the same financial statement. Let's listen to one of my experts.
The matching principle is one of those concepts that we tend to forget sometimes, but we really need to be thinking about. And the whole idea around the matching principle is that we want to match expenses and income to the period that it's relevant to. So when is the income earned and the expenses incurred related to each other? And that's really helpful when we are doing books for our clients, so that if they, for example, received in a big contract and it's $100,000, then when are those expenses incurred? And if we're able to match those together, it helps them really understand what their real profit is in that situation. It's important also because of things like payroll. So when we think about payroll, when is the matching happening? Is it when it was paid or when that pay period happens? And so understanding when to record transactions and things like that, that's really helpful for the client. One of the ways that the matching principle can also be used is based on the types of things that we're able to do in certain accounting programs. So for example, can we match income and expenses by entity? For example, a customer or a project. That is really helpful also, because many times clients are not able to see those things together very easily. It could also be based on lines of business where we're matching income and expenses by line of business, in addition to matching it across periods when we're talking about it from a true accounting standpoint. But as bookkeepers, there's multiple ways that we could talk about that matching principle. And so thinking through that and helping the client understand that is really helpful as you're advising them and going beyond just the data entry mindset of what it used to be a bookkeeper to now being really much more in a position to advise our clients and provide reports that are really meaningful to them that also help them run their business. So as we're running reports, thinking through how the client will get this data, what they will do with that data, how they will see the income and the expenses together in potentially the same period or related to the same project or customer or business structure or business line, revenue line. All of those things can be really helpful and really provide more insight for the clients.
So why does this all matter? If you don't match up your expenses with your revenue, then your books are going to be off and unreliable. They're like that pizza I dropped coming out of the shop last night. Ugh, chaos. 1 month, it looks like you're rolling in dough. The next, you're up to your eyeballs in expenses. There'd be no way to tell what's going on. Yes, I still ate it. And yes, it was still good. Here, let me give you an example. Let's say Lou decides to sell lawnmowers. You know, the big kind. A few months ago, he bought one from a wholesaler for $5,000 and sold it the other day to a customer for $8,000. At the end of his reporting period, now that he sold it, he needs to match up the $5,000 expense with the $8,000 revenue he generated. That way, everything in his books is on the up and up. Here, let's take a look at how it's done in QuickBooks.
So now we're going to talk a little bit about deferred expenses or the matching principle. Basically, what we need to do is record a cost that's related to income in the same period so we can truly see the profitability on that product or service in real time in the same period. So I'm going to demo this using the inventory feature in QuickBooks Online because it kind of does it for you. So first of all, we're going to buy some pens and then we're going to sell some pens. But let's say we buy the pens in January, and let's say we're going to sell the pens in March. So I don't want to go ahead and enter an expense when I'm buying my pen and book it in January to cost of goods sold, right? Because then it would show up cost of goods sold, put it right there. Oh wait, put it right. Cost of goods sold, put it right there. And let's just date this January 31st. So that's the day we bought it. So this is putting straight to the category or account on the chart of accounts cost of goods sold. And let's say I spent $50 buying my pens. Okay, this would show up on the profit and loss statement in January. So I'm going to hit save and close. So if I look at cost of goods sold, my expense is on January 31st and it's showing the $50 here. So if I sell those pens in March, my cost is in January. So when I run the March profit and loss statement, I'm showing less cost than I really should. I need to pull this $50 to March without changing the date that I bought these pens. So let's go ahead and drill into the actual expense I just entered. And instead of using the category area on this expense form, I'm actually going to pull the pen product right onto this purchase. And in this case, they're $5 each, and I'm going to order 10 of those. Okay, so that is my $50. And so I can trash can this row that's going straight to my profit and loss statement in January. This entry recognizes that this is an inventory item, and QuickBooks Online will do something automatically. When you buy inventory, it doesn't go to cost of goods sold, it goes to the inventory asset account. We now own 10 pens, right? So we bought them and we're going to resell them later. Inventory knows to actually book this as an asset. So it's not going to go to the profit and loss today. So I'm going to hit save. And then I'm going to open the transaction journal. If you click more and go to the transaction journal, it'll show the debits and credits underlying this expense that I just entered. And so you can see it is coming out of the company checking account on January 31st, but the debit is not hitting cost of goods sold, it's hitting inventory asset, which then is showing up on our balance sheet. Not going to show up on the profit and loss yet. So how do I get it from the balance sheet down to the profit and loss statement? Well, first of all, let me take you back to the balance sheet, and I'm going to take you, let me run the report again. You got to refresh the other browser tab. And I'm going to go to inventory asset. And in here, my purchase on January 31st, right here, is showing up as an expense for $50. Or not an expense, sorry, it's on an expense form, but it's showing up in my asset listing for the inventory we have on hand. Okay, so how do you get rid of inventory? You sell it. So let's sell some pens. I'm going to go to my invoice, and we'll pull in a customer. Just pick somebody, and we're going to sell a couple of pens here. Promo pens, and we sell them for $8 each. They are taxable, but let's just say this is a wholesaler. We're selling and just marking them up and reselling them. So let's sell all 10 of them. So this is an $80 invoice. So we bought them for $50, we're selling them for $80, we're making a little money here. As soon as I hit save here, QuickBooks Online is going to do something really cool. Because it's an inventory item, it's going to pull $50 out of inventory asset off the balance sheet and down to cost of goods sold on the date of the sale. So let's sell this in March. Let's say it's March 1st. Okay, as soon as I sell this, cost of goods sold is going to show up, and it's also going to record the income and the receivable. So a lot happens when you sell an inventory item in QuickBooks. I'm going to hit save. Let's take a look at that transaction journal and see all the magic behind the scenes. So we'll take a look at the transaction journal and look at all this magic going on in the background. So what we want is we want the income to show in March, and we want the cost to show in March. And this is letting us know that it is happening. The invoice is dated 3/1, but a lot is happening in the background. First of all, it's recognizing the income in March. So accounts receivable has been debited and sales of product income have been credited. So that's the income on the profit and loss statement. Then, because it's an inventory item, QuickBooks Online knows to pull that value of the cost. We bought them for $5 each. The cost came off the balance sheet from the inventory with this credit entry, and we debited cost of goods sold. So now we're showing the revenue of $80 and the $50 cost in the same period. And that's what the matching principle is all about. So when we run the profit and loss statement, and we're looking at 2020, let me go and change it to this month and hit run report. We are seeing revenue here, which would have our $80 invoice, and then cost of goods sold is going to show the $50 of cost, even though we purchased it back in January. So I'm going to click through, and you can see the invoice has created a $50 cost of goods sold, even though it's not an expense form. Kind of funny, huh? But that is the matching principle in action. And inventory does it automatically in QuickBooks Online.
So there you have it, my boss bookkeepers. the periodicity assumption, and all of its magical accounting implications. I hope that you enjoyed listening to me talk as much as I did. If you didn't, sorry, no refunds. In my next seminar, I'm going to talk to you about the difference between accrual and cash-based accounting. It's gonna be a hoot. You don't want to miss it. In the meantime, I'm Bianca, taking you bookkeepers from basic to boss. See you next time. Welcome back to the boot camp, my bookkeeping bosses. You know, after all of our talk about the periodicity assumption and revenue recognition, I got to thinking. Not every business has the same needs or operates from the same financial playbook. Different businesses need different accounting methods. So that's what we're going over today, the cash basis and accrual methods of accounting. The more straightforward method is cash basis accounting. Small businesses love this method because it's easy to use. When you receive a payment or paying an expense, you record it in your books and that's that. Let's take Lou, for example. Lou does not record any activity in his books until he gets paid. Likewise, he doesn't record any expenses in his books until he has actually sent the check. Listen to a bookkeeper friend of mine as they share some insights about using the cash basis method.
So the one thing that I can say to the people, the bookkeepers that are servicing clients that are on a cash basis, is that cash basis can actually be more complex than accrual basis reporting, because cash basis, you're not supposed to have accounts payable or accounts receivable. So you really have to know your stuff. It's actually harder to cash basis reporting than accrual basis reporting. So you should really understand what's involved in doing all the things you need to do for your clients, such as tracking bills and invoices if they're invoicing their clients. But understanding what should be on the cash basis balance sheet and the cash basis profit and loss. It's more complex than it looks. And the other thing that I can say is that whether you're doing cash basis reporting or accrual basis reporting, one thing that you're going to be very valuable to your clients for is producing cash flow reports. Here's the cash you had at point A. Here's the cash you have at point B. There's a difference, and here's why, as well as cash basis cash flow projections. So if somebody wants to know, hey, can I afford to buy this machine based on our receivables and our payables and any other big outlays we have coming up, you can be very useful to them because you can analyze their business and say whether they're going to be able to have the cash in the bank to pay for this. So that's where you can really be very valuable to your clients.
Like everything in life, there are pros and cons to using the cash basis method. This method is super simple to use, and if you're worried about factoring in future transactions and all of that, forget about it. With this method, everything is recorded when it happens. But this method doesn't really give a full picture of income and expenses, just a snapshot of your business's activity. You can't really get away with using cash basis for everything. For example, if your business offers credit to customers, you'll have to use something different. Listen to my good friend share a little more about cash basis accounting.
So most of my clients are cash accounting, and the reason why is it's really is because it's easy to use. They understand it. They understand that once they receive money, that's income, and when they spend money, that's an expense. The other thing that they like is the potential tax advantage. So they don't have to pay taxes on money that's not in the bank, versus in accrual, you basically accrue that money and you pay taxes as soon as you send out the bill. And then the last thing is it's all about having the money on hand. So they're able to see, at a glance where their money is. Like if it's in the bank, that's money that they've received. If it's been taken out as far as withdrawal or a check, that's money that they have expensed. So if they have inventory, you are not able to use cash accounting. It has to be accrual. The other thing is we do have certain income, like income that the IRS requires you to actually use cash accounting. And then the other thing is if they sell products or services on credit, they're not able to use cash accounting. I would say pretty much 90% of the clients that come to me, I recommend them using cash accounting. Because as I said before, it's all about them understanding why they're having to pay taxes on money. So it's easier to explain when they can see that, okay, I made this money and it was income and I classified it as income, and then I have expenses that I have spent. So basically the income minus expenses is your net income. That's what you're going to have to pay taxes on.
The other method of accounting is called accrual accounting. In this method, revenues are reported or recognized on financial reports when they are earned, rather than when the payment is received. Same goes for expenses. They are matched to their respective revenues on financial statements and recognized when they are incurred instead of when they get paid out. Take Lou, for example. He does a job and sends his customer an invoice that the customer pays 30 days later, which falls into the next accounting period. Using the accrual method, he would still need to account for that income on his books, since he already did the job, even though Lou got paid after he did the work. Likewise, if Lou got a bill from a vendor today, but he paid it 2 weeks later, he would still recognize that event as having happened today. You getting all that? Don't worry, here's another expert to give you the skinny.
So the accrual method of accounting requires more detail since it's non-cash transactions, such as amortizing prepaid expenses or even unearned revenue. Transactions like these can easily be missed if we're not asking the right questions and obtaining the right information to properly record these transactions. I worked with a small business owner who would track their books on a hybrid basis throughout the entire year. At the end of the year, they would convert their books into accrual accounting method for financial reporting reasons. It was a big deal. We had to review all of the expenses and bills we received in January to ensure everything was properly categorized and captured in December as an accounts payable.
I think that by now, you've realized that the biggest advantage to using the accrual method is that it gives a better picture of the company's financial condition than the cash basis method. Since all assets and liabilities are reported when they occur rather than when they are received or paid out, this gives a fuller and more accurate picture of the state of the business on the financial statement. This would allow Lou to show that while he may have only received $3,500 in payments in a given period, he actually sent out $5,000 in invoices for his services in that same period. On the other hand, while accrual accounting provides a more complete picture of the company's finances, it is a more complicated method, requiring more time and resources. By the way, that's where all you bookkeeping bosses can come in to save the day. Listen to my good friend explain a bit more about the accrual method.
The accrual method is realistic to what the business is. You can have bills that are outstanding, and then you can have invoices that you've charged your customers outstanding, but you account for that month that you bill it. So let's say you have an invoice that you have billed your client and it's for $100. You have not received that money, but you're going to account for that money given that you're in that accrual method. So you are going to account for that money in that month. And so for your month, your income for that month would be $100, even though you have not yet received that money.
You might be saying to yourself, Bianca, what if I want a little cash basis in my accrual? Lucky for you, there is a third accounting method called the hybrid method. Using this, you can use cash basis accounting to track things like revenue and expenses, but use the accrual method to track inventory. For example, if Lou decided that in addition to mowing lawns, he wanted to sell garden gnomes, he could use cash basis accounting to track his income from mowing lawns, but use the accrual method to track his garden gnomes. The key to using this method is consistency. If Lou wants to continue using the cash basis method to track his income and expenses, that's fine. But he can't just go off and decide to change it halfway through. Your use of the hybrid method must still clearly reflect your actual income. This can be a little tricky, so I'm going to have you listen to another expert explain the ins and outs of hybrid accounting. Make sure you listen up.
So you may hear in the accounting world out there something called the hybrid accounting method. It's just basically in cash or accrual or a combination of those two. So that's basically what we're talking about. It could be that for tax purposes, when they set up the company, they decided to report to the IRS on a cash basis. So that's just beneficial. And usually when you decide to report to the IRS, that's exactly how you're staying. It's going to be cash basis all the time. However, when you're working in the books month to month, your client may want to see what's accounts receivable. Well, that wouldn't be on a cash basis financial. So you could run reports in the accrual basis for day-to-day business operations. So you can see accounts payable, accounts receivable, and other things like that that are going to help the client make decisions, especially when it comes to cash. If they have a lot of receivables and not enough money in the bank to pay all those bills, they might want to see the books on an accrual basis for that purpose, even though they're filing with the IRS on a cash basis. So one reason why a client might have a hybrid accounting method going on is, let's say, sales tax. Maybe with their state, they have to file sales tax on an accrual basis, meaning even open invoices that are unpaid that have sales tax on them, they still have to pay them as if to the taxing authority or the state as if they have the money already. So on the for sales tax purposes only, they might be accrual. However, the rest of their financials might be viewed on a cash basis. So there might be little areas in the books that just need an accrual versus cash. And again, we're using a hybrid method that way. There's a little segment of the accounting that needs to be accrual. So let's say we are using the hybrid method to report sales tax and pay sales tax on an accrual basis when the rest of the financials are all cash basis. So there are extra steps. If you are going to have a hybrid accounting system, you need to make sure that you're ticking off a few boxes to make sure you're accounting and paying things appropriately. So in the sales tax scenario, we need to actually switch the reporting method in the accounting to accrual just to run the reports for sales tax liability, right? So it'll switch it out. It'll be on accrual basis, so unpaid invoices will be included in that sales tax liability number. So it's just a little bit of extra work, but well, it's easy to do once you know what to do. So, and you just have to make sure that you have all those little boxes checked off if you're doing any sort of hybrid reporting. So if you are working with a client who has a hybrid scenario going on there for their reporting, I would definitely make sure whatever project management application you're using in that firm or within your own firm, if you're a solopreneur, you would want to make sure that you have different tasks listed for all of your entries every month. So, clear the bank feeds, reconcile, blah, blah, blah. If there's any hybrid accounting going on there, you need to also add that to your checklist every month. just to make sure everything has been accounted for and to just cover all your bases. But just be very aware that hybrid accounting can pop up every once in a while with a client, and you just need to make sure you add it to your standard workflows.
You know, I can hear you all right now. But Bianca, I'm just a bookkeeper. It's up to the business or accountant to decide what method they want to use. That may be true, but more than likely, you'll be using some type of accounting software to do that company's books. Depending on the method you're using, your books could look different. Take QuickBooks, for example. You'll only be entering transactions once, but you can change your report settings based on whether you're using the cash or accrual method. Here, let's take a look.
So we're looking at a profit and loss statement on an accrual basis right now. An accrual in QuickBooks Online means that this report is reporting unpaid invoices and unpaid bills. That's all that QuickBooks will do. It will show that it's unpaid invoices plus paid invoices for the March period. So if I toggle it, I can actually toggle it to cash basis, which means any unpaid invoices would back out of revenue. So let me just toggle it really quick and run the report, and you're going to see a difference in the revenue. These are just March invoices that have been paid. So it also worked with expenses. So if there were any bills or costs that were booked here to the profit and loss in March as a bill, it would have backed them out if they were unpaid and left them here if they were paid. So now on accrual basis, it's bringing in the unpaid as well. So that's how you can toggle it on a specific report. You can also set the settings for the company overall. Maybe the company wants to report on an accrual basis on a day-to-day basis. It's absolutely easy to do. Just go to accountant settings, and we are going to go to the advanced tab. And go to the advanced tab. And here in the accounting section, I've just opened it up. We have chosen that reports default to accrual basis. You can switch it to cash, but again, on the individual report, you can make the change as well. But anytime somebody runs a report in this company, it's automatically going to show up as an accrual report, but we can toggle it. So that's how you do the overall company setting. One more thing, if you are logged in as an accountant user into QuickBooks Online, you have specific tools. So it could be that the accountant wants to see it in a different way or a different time period. So Accountant Tools has reporting options where when I log in as the accountant, I can choose, I want to see everything in cash and I want to be looking at the previous quarter by default. So I'm overriding the company default, but it's not going to change my client's experience. It's just for me because I'm special and I need special reporting tools. So that's how you toggle from cash and accrual in QuickBooks Online.
Look at you all becoming a boss bookkeeper. Before you know it, you'll be teaching me. All right, that's all I got for you today. I'm Bianca, taking you from basic to boss. In the meantime, be on the lookout for my next boss talk. All right, that's a wrap. Lou, honey, how you doing? You did what? Uh-oh. All right, I'm on my way. Just great. Looks like Lou's messed up his books again. Lou.
The Intuit Academy has created new training for those who are interested in learning all about taxes. Intuit Academy's mission is to offer cutting-edge online training programs that 1. Unlock high-demand job opportunities. 2. Ensure Intuit's customers receive a world-class service from highly skilled experts. And 3. Foster a culture of learning and growth, attracting and retaining high-caliber talent to the Intuit Expert Network. The Intuit Academy is committed to helping learners develop the skills they need to be prepared for jobs in the innovation economy. Whether they own a business or want to switch careers, the Intuit Academy Tax Level 1 training is here for those with the courage to grow. This training is a transformative learning experience designed to prepare all types of learners to take a tax exam. The courses introduce learners to foundational tax topic information using real-world scenario examples. The Intuit Academy Tax Level 1 training is a way for individuals to gain knowledge of tax principles, the tools needed to identify problems, brainstorm solutions, and much more. The training promotes creativity, critical thinking, complex problem solving, and other skills that are valued in today's workforce. This training is key in promoting skills to prepare learners for the workforce and to position themselves as credible job candidates. Those that successfully complete Tax Level 1 will be invited to explore career opportunities with Intuit's TurboTax Live. Individuals who complete the Intuit Academy Tax Level 1 training will be encouraged to add their badge to their LinkedIn profiles, resumes, and other career builder tools. Individuals will also be invited to take future courses created by the Intuit Academy.